What's the best way to cut your losses? This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. I'm Matt Charne, your host for this week's accounting and auditing episode. I'm an audit director at Clifton Larson Allen. And joining me today, as always, is Marissa Flood, Assurance Senior at CLA. Welcome back, Marissa.
Thanks for having me.
This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA or CLA. Okay, so we've got a great update for you guys today. I was actually excited to see this. So ASU 2025-05 was released earlier this month, or I should say earlier in July. And we're not talking about exposure drafts anymore, finally. No more speculation. These are changes to a standard that are coming out. I'll mention this a few times, but these are effective for periods beginning after December 15th, 2025. So anyone who's doing an audit in 2026, January 1st, whenever you may start, and your period end date is 12/31/2025, this is applicable for this year.
Yeah, this is the real deal. No more exposures. This is something to get ahead
Exactly.
of.
No more drafts. We've got an actual change. That being said, it's nothing too crazy. I actually think these changes are great. And the topic in question here is CECL again. So topic 326, or credit losses, for those that aren't familiar. I would think everybody at this point is familiar with CECL. It's been around for a couple of years. Quick refresher, just to kind of go over what CECL used to be, and then we'll talk about what CECL is now. And CECL stands for Current Estimated Credit Losses. And when this standard came out, it affected somehow every business, even though it was really targeted towards like banks or financial institutions and how those guys kind of account for their, quote, credit losses. So what got roped in that affected every single business on the planet was accounts receivable. And I remember when the standard came out, everyone was kind of scratching their heads thinking, well, I used to just account for my accounts receivable by, assuming my historical collections were going to continue unless I had a good, compelling reason to think major customers or segments of business wouldn't collect for some reason. And then I would estimate my allowance based on that.
Yes.
And CECL was saying, well, no, you can't really do that anymore. You have to assume whatever you're going to get will not be at 100%. Unless you have good reason to think otherwise, and then estimate your credit losses, right? So
Yeah.
Everything became very forward-looking. And I remember the implementation for this, we wrote a ton of memos. We work mainly in the manufacturing, logistics, technology kind of space, so not a lot of financial institutions or banks. If you talk to some of those accountants or auditors, I'm sure you'll see that they'll have a very different experience with this, but our memos that we wrote did a lot of in and out and kind of mumbo-jumbo about, well, I have this many collections for, this many past years. It was at this percent. I normally reserve at this percent. They typically match up, so I'm just going to keep it the same. So After jumping through all those hoops, I feel like not much really changed.
Yeah, I feel like it got a little bit frustrating for me. I feel like there was a lot of change that we had to do,
right,
and the clients had to do and think about, and then at the end there was really no material change. And from a manufacturing standpoint, the assets for us were so short-term in nature that it didn't really do much for us.
Exactly. Technology was the same way. I can't think of a single client that I had where we had a really major change in how they accounted for their receivables.
Yes.
At the end of the day, this stuff is between 30 and 90 days. Of course, you get the ones that stretch out and maybe they get to 120, 180 days. You're typically going to put a reserve on those anyway because, like you said, these are short-term assets. And once you get out past that 3-month mark, you're pretty much assuming you're not going to collect anyhow.
Yeah, I was just going to say the way we look at it anyway is anything unusual in nature. So for us, and especially in my industry, like we're seeing a consistent pattern of current receivables within 30 to 60 days. And then, the one-offs, the 120 plus days, we are analyzing anyway because, like I said, we do have to analyze things that are unusual. So
Absolutely. That happens in any case. So the point of this update, as you'll read, is really good because I think the FASB kind of caught on to that and realized that there are a lot of industries out there that aren't financial institutions or banking that don't really have credit losses outside of AR and said, well, this has become kind of a burden now.
Yeah.
And that was the feedback that they got from a lot of business owners, particularly those in the private sector, and came up with this ASU in order to simplify the guidance. So now the two main provisions that I'll point out that are being added are a new practical expedient and then a new policy election for non-public entities. I'm going to read one for one the practical expedient and then the policy election for you guys first, and then we'll jump in a little deeper. But the practical expedient now says that all entities, so public and private for this one, can now elect a practical expedient that assumes current conditions at the balance sheet date will remain unchanged for your asset's life. That eliminates the need to forecast macroeconomic changes like unemployment, maybe some kind of like fair value macroeconomic effect, unless you know something crazy going on. So let's pause there for a second and talk about the practical expedient, because I think that takes that whole thing that we just talked about, where you have to analyze, okay, I've got $1,000 of receivables at December 31st, and then in March they're still open. Do I think I'm going to get them all? Well, I think I will, because typically they pay me within 60 to 120 days. So we're sitting at the 90-day mark. That's not that weird. And I think under old CECL, you would kind of say, well, if it's between 60 and 120 and you're at 90, you're kind of 50% through your period, right? Your estimated period of when you're going to collect. So maybe you should put a 50% reserve on it, because it looks like you're not going to get everything because it's a little bit late. This practical expedient is saying there's really no need for that at this point. These are still considered short-term assets. The economic conditions that existed at the date that you recorded that receivable, which at the date that you recorded it, you would think, I'm going to get everything because I did the work. And, my customer has acknowledged the commercial substance of this transaction.
Yes.
So we can just keep that and keep moving forward.
Yeah, again, especially with the 60-day, 30-day, like the very short-term receivables, this is fantastic for. I think this is going to help a lot, because
It's going to be a lot easier.
It really is, because there's really no need to forecast those changes for 30, 60-day times. I mean, unless it's a completely volatile market, then
right.
Then I don't really think there's a big risk there.
Yeah, and we'll get to that in a little bit, I think, when we talk about some of the scope changes here and what might actually be a little bit of a negative from this change. But if you have a volatile market that you're working in anyway, you're probably not going to slap 100% collectible on your 30-day receivable anyway. It's going to be much more nuanced than that. But let's put that on pause for a second and talk about the accounting policy election for non-public entities now. So now this is for any kind of private company. And it reads, entities other than public business entities can also elect to consider collection activity after the balance sheet date when estimating expected credit losses. This means no allowance is recorded for receivables collected before financial statements are issued, reducing unnecessary documentation and effort. Now, that sounds great. What I realized soon after I read this was that maybe I wasn't really paying attention to all of the provisions of CECL to begin with, thinking that, hey, if I had a receivable, maybe it was $5 million at December 31st, and we collected $2.5 million in February, and we issued our financial statements in March. According to CECL, you might need a 50% reserve because, well, if your terms were 60 days, what happened to the other piece of it, right?
Yeah.
Now, depending on the size of your business and the relationship with your customers, things like that, that may not be unusual to get installment payments like that, and especially if you're speaking with your customers and trying to collect based on whatever cadence that you've agreed to. But the hardcore standards would say, well, you didn't collect everything, so where's your reserve? If you're estimating out and you didn't really negotiate with them, maybe you got a partial payment, you have to assume that you're not going to get something now.
Yeah.
In this policy election, not the practical expedient now, these are two different things that are being created. The policy election is saying there's no need for that. That whole extra analysis going into that piece of it is just superfluous for probably 95% of businesses out there.
Yeah, I agree with them. There really isn't. So again, happy to see this in here.
Exactly. Yeah.
It's nice now because I feel like with applying this, especially for my clients, when we issue the financial statements, we're really not over-reliant. There's no more over-reliance or the risk of over-reliance for this.
Right.
So I think this is going to really help them.
Exactly. Yeah. And one of the other provisions for this was a scope expansion, which is saying that, again, just to repeat, the practical expedient applies to all entities, and the accounting policy election is for all non-public entities. Now, it doesn't say anything specific about what industry or business might be in, and I think that's where the wrinkles start to come into this. Because, again, in the world that we kind of work in, logistics, technology, to a degree, or certainly manufacturing, to professional services, I was going to say to a degree, maybe healthcare. You might have a little bit of a credit issue there just based on how many insurance companies you deal with. So that could get a little muddy. Maybe we'll have to do a follow-up on that at some point. But certainly financial institutions and banks, right? Whoever's putting together financial statements for them, whoever's doing their accounting for these types of businesses, CECL was really designed for that sector, right?
Yes.
And I don't think in this practical expedient anywhere did it say, if you identify as a financial institution, ignore this expedient. So it's to my knowledge still available to you. The question is, do you really want to use it? And I think you had some good points about saying that it may not make sense.
I don't think it really would.
Right.
I guess someone could always argue how it would make sense, but in my knowledge of the industry and how it operates, I don't really think that it's gonna be as straightforward as it would be for your typical manufacturing run-of-the-mill.
Yeah, and that's where we want to stress, the practical expedient is great, and it's an awesome tool that we can now take advantage of to kind of streamline this process here, and we don't have to update our CECL memos every audit period anymore. We can kind of just assume these conditions are going to stay the same. That being said, there should still be an audit procedure every time to think about, does this expedient make sense for my audit, for my client, for my business, whoever might be doing that analysis, and thinking about, like you said, how volatile are my credit conditions?
Yep.
And are those constantly changing? If you're loaning money out to folks all the time and that's your bread and butter, I would think, your situation's always changing and you're always taking a look at those kind of credit terms.
Yeah, and you don't want to miss, especially in this industry, early warning signs or other things that would be captured when you're doing this forecast.
Right.
So it is important to make sure that you're getting the full picture.
Absolutely. Great. So just to reiterate again, the standard is effective for annual periods beginning after December 15th, 2025. So audits December 31st, 2025 that you're going to be doing in 2026, that's applicable for this. In closing, here are a few upcoming NJCPA events you might be interested in. On August 25th, there's a webinar on fraud in single audits. On September 19th, the Society's new North Jersey Tri-County chapter is holding an A&A update in Roseland. And on September 25th, the Bergen chapter is holding an A&A update in Lyndhurst. Get details on these events and more at njcpa.org/events. And be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.